I mean, there's so much conversation about how the markets could be stretched right now. I mean, we heard what Scott Minerd of Guggenheim said. He said, it's a Ponzi scheme. When are you going to get up and realize you're looking at defaults?
Good morning, Haslinda. Good to be with you again. A little colder than it was the last time we were chatting in Singapore, I have to say. So which part of that would you like me to comment on?
So do you agree the market stretch? I mean, do you agree with Scott Minerd?
Well, the underlying growth fundamentals are not bad. Let's start with the positives. So yes, global growth is slowing down, but not dramatically. US is slowing down as well, but again, not substantially. We have accommodative monetary policy, so all of that would augur well. There are areas which concern me specifically. There's about $15 trillion of negative yielding debt, of which, Haslinda, $1 trillion is negative yielding corporate debt. Now there we do need to step back and ask ourselves, how do we feel about leaving our money with corporations, which in the end are fundamentally risky ventures, and getting back less than we gave them?
And the repercussions of that, a few years down the road, what do you see?
Long-term repercussions. So, and they aren't the obvious, well, they'll be beyond the obvious ones. So obviously, if you're going to wind up investing at negative yield, locking in effect, a loss, that's going to have repercussions. But of greater concern for me are the repercussions for pension funds and insurance companies, and those will be felt for years to come.
Anything reminiscent of the 2001-2002 recession at all?
Recession, no. Very stretched valuations, which may lead to very significant markdowns at some point soon, which may create its own impact on global growth. That would be my worry.
ESG, the focus at this conference, how do you price in climate change in your investments? The reason I'm asking that is if you take a look at Australia, we're looking at a stock rally at a time when bushfires are destroying the country. How do you factor it in?
So this time in Davos, I think we have crossed the Rubicon. The world's biggest asset manager coming out and making the strong statement that he did, I think is going to have significant repercussions. In effect, what BlackRock has said is that we care. We are now monitoring companies not just based on earnings, not just based on credit quality, but based on their ESG scorecard. Now let's follow that through, Haslinda. What that means is that the cost of equity and cost of debt for companies that have a good scorecard will outperform those that don't. What we don't have are clear established metrics at this point. I dare say if we continue thinking down this progression, imagine a world where you've got rating agencies that start to assign scores. You could get a AAA all the way down to a BBB. You could be below an acceptable grade. I think that will have significant consequences in the way boardrooms and companies think about their business model. And so if many years from now, when we think about Davos 2020, in some ways, I think we've crossed a major line.
Which markets could possibly be mispricing climate change? I mean, India, possibility looking at deadly smog.
So we can look at it down country lines, we can look at down industry lines, we can look at it down specific corporation lines, and I think there's consequences for everyone. No doubt, I think government policy on this will get challenged significantly. The onus is now on governments to agree scorecards, which then have to be followed.
Since you got to Cantor Fitzgerald, you made several high-level hirings. What environment in Wall Street that's allowing you to do that?
So we at Cantor, Howard and I, have spent a lot of time thinking about what we want to do. We don't want to be all things to all people. We focused on very specific areas. We're very focused on healthcare. Biotech in particular excites us. We've built a very nice business. We're focused on tech. We're focused on not yet public companies and bringing them debt and equity solutions, prime brokerage. And yes, we've been able to attract some exciting young talent.
When it comes to bulge bracket farms, where do you see Cantor Fitzgerald being able to compete best?
Well, we're certainly not bulge bracket. We are focused. You would think of us as niche. So very different business model.
So taking a look at the environment right now, what do you view as the biggest risk?
Stretch valuations. We talked about that earlier, particularly in credit. And it's a very hard environment, particularly in which to be a successful investor, because you can't sit it out. Odds are, if you ask me where we are a month from now, maybe 2 months from now, I would say higher. I would say equity markets likely to be higher, credit spreads to be tighter still. And yet, the asymmetry in valuation, which many of your guests, I'm sure, have talked to you about, is one which worries me as well.